Hello, welcome to this webinar presented by the Pasco Hernando chapter of SCORE. I really thank you for your participation, and I hope the conversation today is useful and we can get some good questions for discussion at the end of the meeting. We have named this webinar Understanding the Financial Statements, mostly because this is a situation we see with our clients at the SCORE, business owners that are really reluctant to discuss financial information and discuss financial terms. And financial information is the language of business. We cannot perform as business owners if we don't master the language of business. My name is Jose Melgar, and I am a certified mentor at SCORE. Let's talk about the SCORE. We have been around for almost 60 years now, and we are in all the 50 states, and our services are free. Mostly our services consist in mentoring and planning assistance. So you do the planning for your business, you make the decisions in your business, and we always offer experience. Everybody in SCORE has been business owner or has worked in the corporate area for more than 20 years. So we share experience. We also offer workshops and seminars like the one that we are having today. All our services are always free. SCORE will not charge you a penny for your participation. As I said at the beginning, my name is Jose Melgar. I have more than 40 years of experience. Before retiring, I was president at Dana Corporation for several years. I have done mergers, acquisitions. I have developed markets in India, Australia, Thailand, South America, Canada, all the US. Have recovered small companies that were in trouble. And I have written many articles in Spanish and English about competition and about business in general. I have been with the SCORE for over 8 years now in different states. What I am planning to talk today are these points, what I consider that is important when we are talking financial information without becoming accountants for the need of more detailed education. It's important that we know what are the main users of the financial statements. And of course, a good business person, an experienced business person, knows how to extract what is essential. We don't prepare financial statements. We are prepared to read them and to extract what is important for the owner. We will touch base on what are the basic financial statements, and I will spend some minutes talking what is an asset and what is a liability, because there are some misconceptions about those terms, and it's good that we are familiar with that. Some minutes about working capital, and then I will include some conversations about what is top line and what is bottom line. Those are terms that are frequently used by bankers or business people everywhere. We at the SCORE always stress the importance of control of the cash flow. Without cash flow, business dies. Let's start with the users of the financial statements. Who are the main user of that information? Is the owner of the business. I find many owners that discuss with the SCORE that are at the middle of April and they still don't have the information about December. because that is something that the accountant prepares for the tax. That is really wrong. The financial statements are designed for the owner. So the main user is the owner of the business. Financial statements have been around for more than 600 years. The Italians started to use them before Columbus, and was always with the intention that the business owner could control what was happening, because the business owner is who has put their money, their savings in that business, and they need to know what is happening in the business. Am I making money? Am I going in the good trend? How much do I have? How much do I owe? What is the value of my business? Those are information that already exist in the books of your company. And it's better that we start making good use of that information. And also, if I am going to ask for a loan, I better know what I am including in my balance sheet or my financial statements in order to convince the banker to lend me the money. So the first user is me. I am paying for the preparation of the financial statements. I better use them. So the last of all this are the tax authorities. Because in case that they are challenging some of the information we included in the declarations, we need to be prepared with the financial statements to defend our position. Because the financial statements are mine. I, the business owner. Of course, many of the uses are for the banks, because all businesses require financing from time to time, and the owner should be prepared to go to the bankers in good shape. And every time the banker will ask for financial projections that are based in the financial statements. There are two reasons why a banker will ask me to have good financial statements. The first one is to ensure that the numbers show the business can stand by itself. They don't want me to take money from the bank and 1 year from now looking in another bank for money to repay this one. That is not how the system works. The bank expects that if they lend me money, my business should be able to generate enough to repay them and give me a profit. That is the rule. That is how things work. So then, what is the number two reason? The banker wants to make sure that I know what I am talking about. I come to them to ask for money, and they start asking me questions about the financial statements. I should be prepared to give good response in order to convince the banker that I know my business. It's not that I am passing the test in the university. It's that I know how my business makes money, and I will ensure that that money will be there to repay the loan. So those are two main things, is that the business is capable and that the owner is capable. That is why it's important that we all learn how to read financial statements and know where we are standing. Most of the people, most of business owners everywhere are in this situation. When somebody brings financial statements, it's a lot of confusing information. It's a lot of papers, a lot of numbers. And certainly, if I am not an accountant, if I am a baker, if I am a builder, I only see a bunch of numbers. I start to get uncomfortable with that. That is why it's better that I learn to find what is essential. I don't need to prepare financial statements, but the bankers and the community, business community, expect that I, as a business person, I could master the key figures of my business. And then I can make comparisons with other pieces of information. If not, how can I control my business? Many people bring complex formulas. Many people try to show that they know a lot, that they are brilliant professionals, and bring charts that are confusing. That is not important. What is important is that the information is easy to understand in a straight talk. So we will explain that in the coming figures, in the coming charts. But that is important, a straight talk. If we are in a networking meeting, if we are in an international fair, going through the aisles, and we start talking about our business, we are not carrying charts. We are not carrying complex information. Well, we should know what is the size of my business, what are my sales, what is the size of my assets. Those are things that I should know by heart. This is what we intend to address today. What is the meaning in the information? There are 6 key figures that is good that we can master. When somebody say they are talking business, if you see in a gathering that there are 2 people that are apart from the other ones and they are discussing, they say they are talking business. Mostly they should be talking about some of these lines. So the first one that is international, that is universal, that has been since the trading exists, is sales. The most important figure in financial information are total sales, monthly sales, quarterly sales, and annual sales. Those are the most frequent. So I should know how much dollars I sold last month, how many dollars I sold last year. So that is number one. And we should be able to find that easily in any financial information from my business or from Amazon business or from IBM balance sheet. So we should be able to find that in any paper of any company. That is what we will be addressing today. After that, I need to find where are the profits. Because I am selling this piece for $100, but not all of that is money that will go to my pocket. How many dollars of those 100 in the end will reach my pocket? So that is in the financial statements, and it's better that I know where to find it. I need to know how much do I own. So this is a company that owns assets for $1 million. Okay, so I have the idea what is the size of that company. Of course, the company owes money, has to pay money to somebody. So it's good that we know that if I have $1 million in assets, I also owe $600,000 to somebody. So in the end, I only have $400,000. Another thing that we should be able to find is how much cash is generated, because cash generation is not the same as profit. I know a company that has a big contract for building a facility in Ukraine and has been invoicing millions of dollars for the work during the first 2 months of this year and recording profit. But now nobody is paying. The government of Ukraine or the people who contracted this person are not capable to pay. So the books show profit, but there is no cash coming. So that is why cash is better than profit. And that is the last solid number, is the number that goes to the bank. And we will see here what is the difference. In the end, for me, as business owner, I need to know what is my net worth, because that is my patrimony. That is what I am planning to leave for my children and grandchildren. And I will be able to identify that in the balance sheet. So this is what we will be talking. Those 6 points is what we need to find in every piece of information in the financial statements. All that information is presented in 3 sets of financial statements. There are only 3. You can see that big companies like Amazon or Apple or Tesla should have books of financial statements. But at the beginning, they have 3 statements: income statement, balance sheet, and cash flow statement. All the other remaining of the book are details of these 3 ones. So these are 3 and no more than 3. So it's not so complicated. It's better that we figure out that there are only 3, and we will identify in the coming charts how it works. The income statement tells you if your business is profitable or not. That is the purpose of it. And it is a list of activities. That is the main conception. Why is different the income statement from the other ones? Because it's a list of actions, activities. So I sell money, I spend money. So it tells during a period of time, 1 month, 3 months, or a year, how much money I sold and how much money I spent. So that is why we say top line is how it starts. In every company, in every financial statement, the top line, it starts with sales, because that is what is most important, the sales. So you go to the income statement and then you look for the first line, that is sales. Or revenue, it has different names, but it's what you have billed. Then it comes the operating section, is how much we have spent in compensation of those sales. Because in order to make money, you have to spend money. So that is the operating, is what the operations, what we pay to our employees, what we pay to our truckers, what we pay to our advertisers, what we pay to the internet, to the phone company, to everybody. That is the operating section. And there are non-operating sections, but those are details that are not the main importance today. After that is the bottom line. So the top line is sales, the bottom line is what is left after all the costs and expenses are deducted. So if I made profit or I made losses. What is important is that it goes for a specific time frame. Income statement for a month, income statement for 3 months, or income statement for a year. Is for time period. This is one example. This is an income statement I took from the internet, and those figures, of course, are just for the purpose of example. This company, the Teddy Fab, had a revenue in a year of $1 million. So that is the top line. That is the most important line. So that is a company that generates $1 million a year. The cost of goods, so the cost of making those parts or buying those parts, were $200,000. So the gross profit was $800,000. So this owner could think, oh, I made $800,000. But there are other expenses. We needed to pay salespeople, truckers, administration, mostly marketing, because marketing takes a lot of money out of our pockets. So $367,000 went to all those expenses. And I had to pay $20,000 in expense for interest. In the end, from those $800,000, only 417 are left. But I made $20,000 in interest that I put some money in the bank to gain interest. So money is coming back. 437,000 is the earning before tax. So from $1 million, this business generated 437,000. And then they have to pay taxes. Taxes take a big chunk. In the end, what they bring home is 197,000. So that is the bottom line. So from $1 million, the bottom line is 197. This is the statement of income. So if I am a business owner, I am interested in this figure, I am interested in this figure. Then if I say, why the money disappeared? So I can start asking questions, and the accountant will explain to me where the money went. But these are the main things in this statement: the top line, the bottom line. And this can be found in any income statement, in any business, small or large. Let's go to another balance sheet. Another financial statement is the balance sheet. The balance sheet doesn't refer to a period of time. That is like a photo, like a snapshot in a moment. So I say March 31st. So how was my business that day, only that day? That is the balance sheet. How was my business in December 31st? So it's a snapshot in one day. We see the difference with the income statement. That was for a year. This is for one day. Because I need to know where am I standing today. So mostly we control that month after month. That is why it's not easy to understand why people can be in the middle of April and still don't have a balance sheet for December. So we are not controlling the company. We don't know where we are standing. So in a balance sheet, there are three important lines that we need to look for. First, assets. Total assets is everything the business owns. All the goods I have to make money. And number two, liabilities is all the money I owe to somebody for different reasons. So I deduct from the assets what I owe. So the difference is my net worth. That is why it's called balance sheet. We see the picture at the right. So we have the assets pulling in one direction and the liabilities in the other one. So if I have more in the side of the assets, I am in better position. Because if I have more in the side of the liabilities, I am losing money. So I don't have net worth. Let's see easily with the example of a house. If I buy a house for $500,000, that is the asset. But I have a mortgage of $300,000. So my equity is $200,000. So the same thing will be in a business, and we control that month after month. Because when the net worth is growing, I am building patrimony. I am building capital. I am building something for my family. If the net worth is reducing month after month, I am going to bankruptcy. So that is why I can never understand somebody who wait 3 months to see the balance sheet. The big companies have the balance sheet of the end of each month in the 4th day of the next month. So you see in the financial market that they already have reported many companies the closing of the books at the end of last month. That is why, because we need to know if we are increasing or reducing the net worth, because that is the owner's equity. Let's talk about assets, because I told you at the beginning that there are some misconceptions. Assets are anything valuable that has an organization. Could be a company, could be a church, could be a non-profit organization, whatever entity has something of value and benefits from that or use it to generate income. This is the main point, is to generate income. Many people say, I have a car and my car is an asset. It's not an asset. Unless you use your car to make money. If we are an Uber driver, yes, it's an asset. But if I use my car to go to my office and come back home and go to give a ride to my grandchildren on the weekends, that is not an asset. Asset needs to be in the books to make money. And this is the list of what the most frequent are. Of course, cash. The money we have in the bank is an asset. The receivables. So invoices I issued to my clients because they didn't pay the day they took the merchandise, but will pay 2-3 weeks later. That is receivable that will be converted into cash in 2 or 3 weeks. That will become cash. Inventories, like these ones in this picture. What is in these shelves? Those are things I am planning to sell in the next month, in the next 2 months. So they will become cash in 3 months. Those are current assets. Is that will speed up the money, will be fast. Prepaid expenses is, for example, the insurance. They charge me insurance 1 year in advance. So I pay the full year and I will receive the benefit along the year. So every month I am taking a portion of that and it's becoming an expense. But I still have a portion that if I cancel my deal with the insurance company, they will give me my money back. That is why it stays there in the current assets. And then there are fixed assets. Are those assets that help me to make money, but I am not planning to sell them. Equipment, vehicles like trucks to transport merchandise, and properties. In this picture, what is in the shelves is current asset. This forklift is fixed assets. Why? Because I am not planning to sell it. My business is not to sell these trucks. This property, the building, is a fixed asset. I expect to keep it for 50 years, that my family will enjoy that building for 50 years. So it will not become cash next month or next year. The only thing that will become cash are the things that are in the shelves. Those are current assets. And the other ones, the bank needs to know if they are fixed or they are current. So this is the definition. And now if we see them in a balance sheet, we can understand why it's important where they are located. Now liabilities is everything I owe to somebody else. Are obligations from past event. So I had people working for me for the last 2 weeks, but I will pay them at the end of the month. So today, that is a liability because I received the benefit of the work, but I have not paid it. I have an obligation. So that is a liability today. So there are mostly, I would say, these three big groups. There are other ones, but these are the most important. So the bills I have to pay for goods I receive. So if I have a bakery, all the flour that I received last week, all the materials, the oil, everything that my suppliers brought. So they gave me a bill, I have to pay them in 2 weeks. So I owe that money, but I am enjoying that benefit today. Debt is if I have a contract with the bank and they lend me money for 3 years, or I have a mortgage for 20 years. So then those loans go in the long term. The same thing with the assets is with the liabilities. What I owe to pay in the coming months, they go as current liabilities. Current is because the suppliers gave me the materials, I will pay them in 2 weeks, and I will take another set of materials, and I will pay them in another 2 weeks. That is why it's current. It's a flow. It keeps coming and going. The mortgage doesn't. Mortgage stays. And I will have to pay that in many years. But it's not going to gravitate on me next month, only a small portion. That is why they are listed in different lines. And the taxes. If I am collecting sales tax, I have to pay that in the next month. And the income tax, I have to pay that in certain specific dates. So those are the three big groups of liabilities. This is an example of a balance sheet. So again, these are fictitious numbers, but the idea is what we need. The important thing, why is called balance sheet? Because always have to balance. You see this column, total is 472,000. At the right side, 472,000. Always the assets have to balance with the sum of liabilities and net worth. That is why it's called balance. You remember that picture of three guys pulling in one direction and another one in the other direction, because in the end, it needs to balance. So this company has total assets of 472, but current liabilities of 47,000 and long-term of 200,000. So total liabilities, 247,000. That is everything this company owes at that day. So we have to deduct this from the total assets. And this is the net worth. This company has 197, that was the profit that we saw in the income statement, plus the capital they put at the beginning. So it has around $230,000 in net worth. This is what is the patrimony of the owner. Retained earnings, that means that the company is making money. So this is the important thing. Total assets, total liabilities, and the net worth. They have to balance, always. Somebody will prepare this for you, but you will be able to understand what is the meaning. You will look for this total line, for this one, and then you know that the difference is yours. Then let's talk some details. From these 472,000, there are 149 that are current assets. These are the things that will make into cash in the next 1 month or 2 months. So this is the cash that is already in the bank, 20,000 in receivables, 15,000 in inventories. So in total, 149,000 is the current asset. Why is important? Because somebody could be very happy with the number of 472,000, but only 1/3 is going to become cash. The rest is the building that is not going to become cash tomorrow, and the equipment. So it's important to see that 149, 472. And then the liabilities. This is another important comparison. 47 versus 149. I have $149,000 that will become cash soon, but I only have to pay 47,000 in the same period. So I am in good shape. I am not going to be in problems in the short term to pay my debts because I have more than enough. I have 3 times what I owe in this case. This is not the situation in most of the companies, but this is only for example. So this is the balance sheet. Important thing is that both sides always total the same. Let's talk more about working capital. The working capital is what we use in the day-to-day trading. What I said, for example, what I receive from my suppliers that I am using today, I will pay it in 2 weeks, but I will have again more. It's presented in this cycle here. This is a never-ending cycle. So it becomes cash. Cash becomes inventory. Inventory becomes sales. Then I collect that from my client, becomes cash again. So this is the cycle. Why is important? Because this is what will keep my business alive. If this cycle stops, my business dies. This is the flow of blood. And this is the first thing a banker will see in my numbers. How much do I have in current assets? How much do I have in current liabilities? So the banker, in this case, will say, if I lend $60,000 to this business, they have no problem to pay me because they have $100,000 in net working capital. Then they can repay easily this. So this is what they see, this comparison. And we as business owners need to be prepared to defend this position. In case that they are not good numbers as these ones, the banker could say, okay, why your current liabilities are so high? So we will need to be prepared to say how we are going to fix that. So this is what is called working capital. And this is the blood of my business. Let's talk about the importance of the cash flow. Why now the cash flow statement has become one of the three main statements? Because for centuries were only two, income statement and balance sheet, for 500 years. But then in the 20th century, after the Big Depression, the market started to insist, and the bankers to insist in control of cash. Because when we are out of cash, that means bankruptcy. That means I cannot pay my suppliers. That means the end of the company. So that is the best advice any business person can receive is never, ever run out of cash. In any decision I make, I need to know how I am going to avoid being out of cash. because that is the definition of bankruptcy. You see the chart of cash in this board of directors went to the floor. So then the chairman says, what now? What can we do? So this is a really tough situation. And for that is that we better get familiar with the cash flow report, cash flow statement. This goes for a period like the income statement. This is not a picture, this is a report of a period. So we say in this case, for the year ended in December 31st, this company had a profit of 79,000. This is coming from the income statement of this company. Let's go back. And then adjustment for depreciation and for increase in inventories. So this company increased inventories. So that means that took money out, $22,000 to buy that inventory. Was cash that went out. But decrease also accounts receivable. So collected money that was owed from the clients in 12,000. That is cash coming in. So in the end, the $79,000 in the income statement was only 71,000 in cash. But the story doesn't end there. Then this company uses some of the money to buy equipment, $12,000, buying a computer, buying another pieces of equipment, and sold all the equipment for $10,000. So in net, had to take $2,000 out of the pocket. So money is going out. And since they have a loan, they have to pay during the year $5,500 to the banks. So that's money out. This means that this company made a profit of 79,000 according to the income statement, but only 63,000 are going to the bank. So we see the difference. We see why it's not the same. We see why saying I am making a big profit is not enough for a banker, or is not enough to declare a dividend. Because you declare dividends with cash. This is important that we see the difference, and why the bank will insist that we make a projection, how the money, the cash will come to the company and how the cash will go out. So it shows, the report shows sources of cash, where the money is coming from, where the money is put to, why I am using that, why did you buy that equipment, or why are you planning to buy that equipment. So these are the main components. Cash coming from operations, from investing, and from financing. Those are the three sources. And all the information is coming out of the other two statements. So if you have balance sheets and you have income statement, then the information is there to prepare this one. Again, the owner of the business doesn't prepare this. Somebody prepares them. But the owner of the business needs to understand them, needs to be familiar, be fluent with the information that is here, and can make better decisions. The information in financial statements is to enforce, to make you better manager of your business. So these are the takeaways of this conversation today. We discussed how to use financial statements, who are the users, how to extract what is essential. We don't need to prepare them, we don't need to know all the details, but at least what is essential. That there are only three basic financial statements. Now we know what is an asset, what is a liability, importance of the working capital. So all these are the takeaways of conversation today. And so I expect that this gives you a brief explanation of how SCORE can help you. So if you need more details, if you need more conversations about your financial information, you can touch base with our chapter, with Pasco Hernando SCORE at the website that is listed down, and ask for a mentor to be assigned to your business and work one-to-one with you. That person will dedicate a lot of time to discuss with you and guide you to better deal with your problems. So now I will review the chat to see if there are any questions. Say, what is deferred liability? There are liabilities that you don't have to face immediately for different reasons. Some could be contingent, and mostly could be similar to the example I presented of the insurance. The insurance was in our side, but we paid in advance and will be deferred for 12 years. So that will be example like obligation when you issue bonuses, for example, bonus. So you issue bonds that you will pay in 5-10 years. And then you issue coupons that are in those bonds. So people will come with them in 2 years, 3 years to collect them, but you don't have the obligation now. So that is not very frequent, but are those liabilities that will happen in the long future. I thank you for your participation and invite you for the coming webinars every month. So we will be hosting several webinars during May, June of different topics, and you will be receiving the invitations. Thank you for your participation. With this, I end the conversation. Have a good rest of the day.